Hey folks, Silas here from Trade Trading. Welcome back to the channel. Today I want to present a case to consider being bullish the long bond or the 30-year. Now there are many ways to play that. We're going to talk about that, but let me tell you why we are presenting a case for a bullish view. So we are basically expecting bond prices to rise, which means yields to fall. This can be due to several macroeconomic factors, market and policy scenarios. So here is just a basic general structure on why we're going to consider position ourselves in the bond market. Then we'll break it down with some data to back that up. So one, a potential economic slowdown or recession. So if we have growth deceleration, slowing GDP growth or contraction, that will lead investors to seek safer assets, which will flow into the fixed income and bond market. If we have continued unemployment trends, rising unemployment, typically bullish for bonds. Central banks may respond by cutting interest rates, which would boost bond prices. Consumer weakness. If retail sales, consumer confidence, or housing market data weaken, it will signal a less robust economy, increasing the appeal of fixed income. Central bank policy shifts, i.e. the Federal Reserve. If we have rate cuts that are expected, if the Fed or other central banks are expected to cut rates, bond yields will likely drop, and therefore bond prices will rise. End of tightening cycles. Markets often price in a rally in bonds when rate hikes are believed to be over. Other factors, falling inflation or disinflationary trends, CPI and PCE cooling, slowing inflation readings increase real yields and make fixed income more attractive. And then lastly, we factor in geopolitical or market uncertainty, which we are in an environment right now. Bonds are considered to be a flight to safety asset. So times of geopolitical tension or a risk-off situation where people are dumping stocks and precious metals, that can move into treasuries and other government bonds. And any type of equity market volatility, now this is the time of the year where volatility can ramp up. So if stock markets start to experience turbulence, bonds serve as a portfolio hedge. So with that being said, now let's look at some hard data and why we may want to consider getting long. So right now you're looking at seasonal data going back to 1997. So we've got a 10, 20, and 30-year overlay here, and this is where we are at the time of this recording here in the middle of May. Well, we can all clearly see and agree that the markets make a significant turning point or low here in mid-May and then drift higher until about the end of August or early September timeframe. If you look at the percent of positive months, May, June, and July are some of the strongest months, and then we tend to taper off as we head into the fall. And then we also see the monthly average performance here in May, June, and July. All positive months, all of the histograms are sloping higher, which means we should therefore be looking to become buyers. And so what this does is it leads us to a scenario of price and time. Are we at a place in price through the lens of technical analysis that aligns with time? So here we are in time. If we look at current price, notice here that we are at a multi-week, multi-month, and actually multi-year base here in TLT, or the ETF that represents the 20-year duration length in bonds. So if we take a rectangle tool, all we've got to do is, with our naked eye, is map out some significant lows here where price has held in the past and then also had a reaction. So you see every time that we've gotten down into this area, we've had a nice reaction from these lows, and we are expecting a potential breakout right here, building a longer term base that can shoot prices to the upside. One last key data point that we want to look at is the CFTC COT data, commitment of trader data. Now on the surface, you're going to see something of interest. You're going to see that non-commercial hedge funds traders are heavy net short to the tune of 100,000 contracts. It gets even worse if you look at the 10-year note, which they're short almost 950,000 contracts. And if you look at the 5-year, 2.3 million contracts net short. And so what this means is that if we start to see a changing of the tide or a turning of the ship, we could see, i.e. massive short covering or liquidation, and then new longs added to that, that can lead to some of the explosive moves that we like to track, follow, and trade inside of our trades trading membership. So we've got all of the stars starting to line. We've got We're facing potential recessionary risk, potential geopolitical and equity market volatility. We've got bullish or favorable seasonality backed by years of data. We've got price in line with this seasonal, and now we have hedge funds caught record debt short. If they start to short cover, be careful, be on the lookout, and make sure you're positioned to the long side to ride that wave. If you like this video, make sure you like it and hit the thumbs up, and we'll see you on the next update.